Hosting our discussion today is Romina Baccia. Romina is our Grover M. Herman Research Fellow in Federal Budgetary Affairs. She is also Deputy Director of the Thomas A. Rowe Institute for Economic Policy Studies. She researches and writes on Social Security, retirement accounts, and the effects of federal spending on economic growth. She also addresses taxes, entitlements, spending, energy and environment, and regulation here at Heritage. Please join me in welcoming Romina Baccia. Romina?
New York will be destroyed, tweeted Governor Andrew Cuomo last month. This will drown the middle class, tweeted Senator Todd Kaminsky from Long Island earlier this month. A total betrayal for New York. A bit extreme, perhaps. Suggestions that lawmakers may eliminate state and local tax deductions have certainly stirred up some strong feelings among lawmakers in Congress and across the states. One of the biggest deductions in the federal tax code, with a value well in excess of $1 trillion over the 10-year period, the state and local tax deduction has become one of the most controversial issues in the current tax reform debate. Here today to speak about these issues are Pennsylvania Representative Seth Grove, American Legislative Council Vice President Jonathan Williams, and Heritage Foundation's Rachel Gressler. I will briefly introduce our three speakers, and then we will have a moderated panel discussion. First, I will ask questions of our panel, and we'll talk about some of the issues involving the state and local tax deduction. And then during the later part of our program, you here in the audience will also have a chance to ask questions, and we can also take questions online. Please join me in clapping after each introduction. Representative Grove comes to us from Pennsylvania today. He serves in the 196th district since 2008. He's a consistent advocate for streamlined, more efficient government and conservative principles. And he attributes his sense of civic responsibility to his grandfather's service in World War II and his father's service in the Vietnam War. Representative Grove worked for 3 lawmakers before serving in office himself. Thank you for being here today. Jonathan Williams is Chief Economist and Vice President for the Center for State Fiscal Reform with the American Legislative Council. He is a tax expert, co-author of Rich States, Poor States, along with Dr. Art Laffer and Steve Moore, and he was formerly with the Tax Foundation. Jonathan, thank you for being here today. And it's my pleasure to introduce my colleague, Rachel Gressler. Rachel is a research fellow in economics, budgets, and entitlements here at the Heritage Foundation. She works on tax policy, pensions, Social Security, and she also oversees our project to reorganize the federal government. Previously, she was a senior economist with the Joint Economic Committee in the Congress. Rachel, thank you for organizing today's event. Before we dig into the details, Rachel or Jonathan, if one of you wants to just briefly explain what is the state and local tax deduction and how is Congress proposing to change it?
I can take that one. So the state and local tax deduction, what it does is it allows individuals, only those who itemize their deductions, that is, who have a significant amount that they can deduct. That's about 30% of taxpayers. It allows those taxpayers to, first of all, pick whether they want to deduct their income sales tax that they pay to their state. If they're in a state that doesn't have a high income tax or has no income tax at all, they can instead choose to deduct the sales tax that they pay to their state government. And then on top of that, they can also deduct the property taxes that they pay. Over a 10-year horizon, this costs about $1.3 trillion in lost revenues to the federal government. That's a benefit that all those people who make those itemized deductions receive in terms of lower federal tax bill. What the current Tax Cuts and Jobs Act proposes is to get rid of all the state and local income and sales tax deductions, But because there are a number of lawmakers in very high tax states like New York, New Jersey, California, that they need to get votes on, they've decided to keep the property tax deduction up to a cap of about $10,000.
Thank you, Rachel.
Mhm.
And what impact does the current deduction have? Jonathan, do you want to take that?
Sure. So we at ALEC and our members have been very active on this issue. It's a very confusing issue, I guess, on the face of it, if you're not in the weeds on tax policy. In fact, when you mention SALT, generally the first hits you'll get are from nutritionists or folks looking at Ronald Reagan's arm treaties deals from the 1980s. But when you look into the SALT issue, it's something that is so important to our members because it really it harms our economy, it harms taxpayers in three major ways. First of all, it drives tax rates up elsewhere. And so repealing SALT will finance very important rate reductions that will bring growth to this economy. And what we're seeing in the House Republican plan this week, as Chairman Brady is marking it up as we're here, is important to get rates down. And we're glad to see that the income and sales tax portion of the deduction are going away in full, and the property tax deduction is capped at $10,000, as Rachel said. Secondly, it's an issue of fairness. As Rachel said, it only applies to itemizers, which are roughly 30% of filers today at the federal level. That is expected to go down significantly under whatever plan we get adopted this year. And also 53% of the benefits of the SALT deduction go to just 7 states. So it is really a benefit to high tax, high spend states. And then finally, and this is probably the most problematic issue that we have with SALT, is it creates many perverse incentives for state and local governments to spend more than they would otherwise and to tax more than they would otherwise. You look at a state like California today, highest income tax rate in America, 13.3%. Studies have shown, I think this may have been in Rachel's study, that the effective rate of that is 8%. And who pays the difference between 13.3 and 8%? It's the rest of the federal taxpayers across the other 49 states that are financing California's top in the nation rate. Also, as we sit here, Governor Bill Walker in Alaska is an interesting case because it was the only state to ever eliminate its personal income tax. That was done nearly 40 years ago. And as we sit here, Alaska legislators are talking about ways to solve their budget crisis. One of the ways they're looking at doing that, Governor Walker's plan, is to enact an income tax for the first time in nearly 40 years. And he said for a couple big reasons, and he's actually selling an income tax on the taxpayers of Alaska, the hardworking taxpayers, as will be your ability to write off that tax on your federal return. So it's not just in theory that we think this is going to incentivize higher spending and higher taxing. It is being used directly as a reason, as a rationale to enact Alaska's first income tax in 40 years.
So you briefly mentioned how that Congress is proposing to change that deduction currently, eliminating the state and local sales and income portion, but still allowing for property tax deduction. Is that right? Mm-hmm. Rachel, can you explain a little more what the new proposal would do and what effects you think that might have?
Yep, so by eliminating the state and local income tax deduction, you do still get a big chunk of those revenues that otherwise would have been fed back to high-income individuals and high-tax states, but it's still going to cost a fair amount. And so on net, these two deductions combined is about $1.3 trillion in revenue. Back of the envelope is that keeping the property tax deduction is going to cost about somewhere between $400 and $500 billion to keep that in there. Now, the consequence of that is that you can't reduce those marginal rates as much, and that's what we've seen in the bill, is that they still have that highest top marginal rate, and they even have a hidden surtax rate above that. And if you were to get rid of those deductions completely, deductions that have no benefit to the economy and actually harm it in many ways, you could instead have a lower rate that would actually benefit the economy. So this is just a big cost that's kept in there for political reasons, unfortunately, and we'd do a lot better if you could just wipe it out completely.
Thank you. Representative Grove, you signed on to a letter, I believe, that ALEC was sponsoring for lawmakers who oppose the current state and local tax deduction. What made you sign on to that letter? Why do you support this policy?
Well, I think if you look at the general principle of tax reform, it's not for more spending for the government. It's actually to incentivize our economy and grow our economy. As a state legislator who hit an economic slump last year, Pennsylvania is still not kind of out of the recession through our economy or the recession through our economy. It's imperative that we continue to grow an economy. And by doing tax rate adjustments, broad-based tax reform, we're able to get there. Pennsylvania is unique. We have an income tax. We have the lowest rate of income tax, and I just sent out my newsletter recently. And this year we balanced our budget through $1.5 billion of bonding. Not the best financial decision, but I actually had a constituent email me and said, instead of borrowing money, why don't you just raise the income tax? After all, it's just a federal write-off. And to think about tax policy, economic policy as just a tax write-off is to me problematic to discuss what we should be spending and overall taxation. So I signed on with 135 different legislators from across the country. We need federal reform desperately.
Jonathan, who else signed on to this letter, and why are some lawmakers whose states will be impacted by this change in policy and who might find that they face tighter state budgets after this gets implemented? Why are they supporting this policy? What have you heard from those lawmakers?
Well, that's an interesting story. So we released our open letter to Congress weeks ago. We're now up to 36 states represented, about 140 different state and local elected officials saying, get rid of SALT for lower rates. It's not in isolation, as Seth said, but it's to finance lower pro-growth rate reductions. And we're hearing several different messages from those lawmakers. So from the low-tax state lawmakers, they look at California. They look at a state like Illinois, almost as close to a failed state as you can get, I think, today, who hadn't had a budget in 2 years, has about $15 billion in unpaid bills. You saw the lady who won the lottery won't even get her payout because their state finances are in such bad shape. They're looking at those states and saying, why are we subsidizing their spending and their taxing practices in the high tax states? So that's one kind of subset of the group. The high tax state lawmakers, and I guess Pennsylvania does fall into that with certain taxes at least, and so Seth can help describe, I think, his rationale to some extent. But the other message that we got was, we're looking to do things right at home. We realize we have a problem at home in the high tax states. They want to cut spending, they want to cut taxes, and this will help them make that case better to their population and to their citizens, because once that artificial federal subsidy goes away, people see the real cost of their spending in their state and local governments back home, and that drives pressure to lower tax rates and to get spending in check. That's the positive message we've been hearing, and that's why we have more than 10 or 11, 12 states that were in that high tax range. We have members signing on from all of those high tax states, and Seth Grove is one of them.
Could you mention some of the policies that are being encouraged by this federal tax subsidy? Like, what are some concrete examples on the state and local level of things that governments are engaging in because it's just a federal write-off, so why not? Either one.
I can start here because something we haven't talked about is there's actually also a deduction for municipal bond interest. And so when the states issue bonds to finance public infrastructure spending, the individuals that earn the interest on those bonds can deduct that interest from their federal taxes. But as a result of that, you're encouraging states to overinvest in infrastructure and to spend money on projects that would better be left to the private sector and could be done more efficiently that way, or on useless projects. And actually 20% of these public infrastructure projects have actually been private ones. And so you have cases where the federal government over the past 15 or so years has subsidized through this deduction 36 professional sports stadiums being built in state and local districts. This is not something that the deduction was set up to intentionally be subsidizing here. And if you look historically, so this is kind of seen as free money. Why not just go ahead? We don't have to pay for it now because it's a bond and it's not going to be, the payment's not due until long into the future. And also it's a subsidized bond. And so if you look at the ballots that were on the 2016 election, if voting for public infrastructure finance projects, 86% of voters approved those. If you look at ones where they said, okay, a public infrastructure project that's going to be financed by an increase in your gas tax, 7% of those were approved. So this has a big impact on how people in the states are deciding, should we do a gas tax and actually have to pay for it now and feel that impact, or should we do a bond that's going to be paid by future taxpayers as well as subsidized across all federal taxpayers? So it's a really bad incentive here, and it's not encouraging good policy.
There's also some inequities in terms of who ends up paying those foregone tax revenues and who ends up benefiting from the current state and local deduction. And is the municipal bond deduction, is that eliminated in the current tax proposal? Or
No, that's not part of the discussion
so
right
that
now.
is retained?
It's retained, yes.
And do you know how much foregone revenue there is from that single provision?
The municipal bond interest deduction, if you eliminated that as well, it'd add about $400 billion over 10 years. So you'd go from $1.3 trillion from all of the SALT deductions to $1.7 trillion. That's something that we actually estimated here at Heritage Foundation. We ran this through our individual income tax model and said, if we get rid of all the state and local tax deductions and the municipal bond interest one, how much could we reduce marginal tax rates by? And we did this in a revenue neutral way and a distributional neutral way. So everybody sees the same percentage reduction in their taxes, and we're not increasing or decreasing total revenues on net. Well, the biggest break would be for the middle income brackets, and they could have a 16.4% reduction in their federal tax rates. On average, it's about 7 to 8% reduction. But this is a significant chunk of change that is in large part being left on the table by not including the municipal bond and the full property tax deduction there. And I would like to talk a little bit about these inequities in this state and local tax deduction, because you do have huge benefits flowing not only to those high tax states, but to the highest earners. So I looked at, comparing across the states here, and just on average, so 30% of people on average claim these deductions, but in some states it's only 17%, like West Virginia, and then in a state like Maryland, the highest one is 46%. The average value, that's the amount that your taxes go down as a whole, your federal taxes, because of the state and local tax deduction, is a little less than $1,000 for a family that's making between $75,000 and $100,000. So middle to upper income households, about $1,000 average value on that. What about millionaires? It's $100,000 that they're getting from this deduction. So this is huge. You have millionaires in California and New York who are deducting close to $500,000 in state and local taxes that they're paying, and they're getting about a $200,000 reduction in their federal tax bill because of that. That's not something that the federal government needs to be supporting and subsidizing and maintaining. You'd be far better off getting rid of those things and lowering the tax rates.
Some people have called this double taxation, if you have to pay your state and local taxes and then you have to pay your federal taxes as well. Can you address that claim?
Mm-hmm.
Sure, I'll take a crack at it. So, one of the things, and this is kind of a, I think, misinterpretation of what double taxation actually is. So when we think of double taxation, the most common example is, let's say, a corporate income tax, which is paid on corporate profits at the federal level. And then once again, if dividends are paid out, individuals pay individual taxes on the dividend portion at the federal level. So at one entity is taxing the same income for the same basket of goods. And so I guess I'm kind of an old-fashioned tax policy guy coming from the Tax Foundation. I'm a benefits principle guy. I like to think that the dollars that you're paying in go to finance a basket of benefits at certain levels of government. When you look at state taxes being paid, it's financing totally different spending at the state and local levels of government. So it's not double taxation in the sense that a corporate income tax or, let's say, a death tax would be, that money that's taxed once or twice at the federal level and then taxed again at the time of death. And so it's a total different interpretation of the term. I would say that originally when the SALT deduction was at play, this was a much different argument in that federal marginal tax rates pre-JFK were the 90% range. You add state rates to that, and you're looking at nearly 100% taxing. So there was a argument back then with extremely high federal rates that maybe you needed to deduct the state and local rates to keep people below the 100% marginal rate. Obviously, thanks to JFK and Ronald Reagan, we're nowhere close to those rates anymore. Much different time.
We talked a little bit about some of the trade-offs that will have to be made here, and the fact that we're leaving $1 trillion on the table by potentially retaining the property and municipal bond deductions. That means that other taxes can't be reduced as much, rates can't be reduced as much. Representative Grove, if this idea of trade-offs of other taxes that have to be higher in order to cover the state and local deductions that might remain in place and those that we have today, if that was something that appealed to you as well, what would be some tax changes that you think your constituents would benefit the most from?
So when you think about Pennsylvania, you probably don't think about huge business taxes. You tend to, like, the more socialist countries really penalize business investment. We have a 9.99% corporate net income tax rate. I scored as the highest corporate net income tax rate in the entire country. Iowa, their top rate is about 10%, but they have a progressive system. We have a flat 9.99. Think about adding that on top of the 35% corporate tax rate. I don't know of any country in the world that has that high of a corporate net income tax. So our little state of Pennsylvania, in the scheme of the world, has probably the highest corporate net income tax in the entire world. It is bad for our economy. You know, we're trying to lure Amazon to Pennsylvania. They start scoring it. You're not a right-to-work state. You have this 9.99% CNI. Obviously, you can hire smart accountants to reduce your liability in that, but it's a fear factor. We're competitive with a number of states. We have Harley-Davidson, small mom-and-pop motorcycle manufacturer in our county. They've shifted jobs to Kentucky. Less taxes, right-to-work state, more flexibility within their management style. So we're at a huge disadvantage, and having the trade-off of saying, okay, we'll forego our state and local taxation. And I'd rather have the discussion and have people see that tax bill and say, oh my gosh, what are you spending so much money on in the state of Pennsylvania? Where's my money going? I don't want my Pennsylvania residents view it as a tax write-off of, okay, so you're spending more, I'll get some more back on our tax reform. That's not good economic policy. I don't want to have those discussions. I want to have actual discussions about what are you spending money on and why are you spending it. So I view this as a huge incentive for the United States of America. I see it as a huge incentive for the Commonwealth of Pennsylvania, and help us at the local level, at the state level, start talking about what are we doing to reduce our CNI to make Pennsylvania more competitive in the world globally? What are we doing to limit spending? I would love to see the property tax deduction removed too, because we have some high spending school districts between pension costs, school employee salary increases well above the rate of inflation every year, locked in for 3 or 4 or 5 years on end. Having those discussions about the spending of government never happen at the state level because of all these write-offs and people just viewing it as, it's just a tax deduction, not a big deal. And I love the left, their attack on this. This is for the wealthy, right? This is for the wealthy. We're eliminating income tax deductions that affect the wealthier far more than it does the middle class or more impoverished people. So I hope Congress kind of pushes back on that line of public argument a little more, because it is not the case.
Something that Representative Grove said there, I think, is so key, in that those of us that believe in federalism and conservatives, we should want these decisions made at the state and local levels of government, not in some far-off Washington, D.C. So the idea that we have tax competition, you mentioned we work on the book Rich States, Poor States every year that we publish with Steve Moore here at Heritage and Art Laffer. We talk all about the value of tax competition, competing with each other for providing the best basket of goods and services and the lowest cost possible. We're seeing that play out every year. New York is losing, California is losing, Illinois is losing, Florida and Texas are winning. The more that we can incentivize that competition between states to provide goods and services at the lowest cost possible, those decisions ought to be made at the state capital levels and the individual town and county levels. That is where we win in terms of getting government spending down, not when these decisions are made here in Washington and subsidized.
I'll just add on to that the impact of this decision to keep the property tax in there, what will that do to state and local governments' overall decisions on taxation? Well, if your residents, or some of them, can deduct their property tax bills, then you're going to shift your taxation from income and sales tax that are no longer deductible over towards the property tax. On net, okay, that's fine for the people. It's even better off for those who itemize their deductions. But about 15% of people making under $75,000 itemize their deductions. So the chunk of your base is going to be worse off because of this, because now they're going to have a significantly higher property tax bill. That's something that, you know, if you're underwater or if you're close on your mortgage, that's not something that you can just eat up, and they're not able to deduct that anymore. So this is something that could potentially harm middle to lower, even middle upper income homeowners across the states if the property taxes go up significantly.
Can I jump in?
Yes.
I'm going to go back and hit on the municipal bond aspect. Incentivizing bonding is not a good thing. The only people that make money on bonding are bonding attorneys. We were going through a drill this past budget year. A group of us got together. We all have these restricted and special funds that have been created in Pennsylvania over 20 or 30 years. About $12 billion worth is just sitting out there in these little pots of money. So instead of our thought process, instead of bonding $1.5 billion, let's take all the surplus of all this money out there and draw it back to $1.2 billion. It was interesting to find that in the past legislators and governors allow some of those special funds money to actually be bonded on top of that. So not only are we were looking at a huge bond to fund the budget, but our mechanism to not bond money was already dedicated to previous bonds, and there's nothing you can do. You're locked out of touching that money for 20, 30 years down the line. When Pennsylvania first approved gaming back in the early 2000s, there's supposed to be this statewide economic development money to spur the economy, yada yada, more corporate welfare. The governor at the time, Ed Rendell, bonded all of it, and we have a beautiful new stadium for Pittsburgh Penguins, some stadiums in Philadelphia, which I don't think they actually win championships anymore in Philadelphia. So I don't know why we did that, little internal Pennsylvania thing, but. It takes away the future General Assembly's ability to say, what is that money originally going for, and do we need to fund that anymore? We have special funds we found dating back to 1900s, 1908, money just sitting there for no apparent reason. Locking future General Assemblies and having that bonding discussion is so important. And anything that incentivizes bonding is a bad thing because a lot of legislators view that. Obviously, in Pennsylvania, it was viewed easier to do a bond to cover a $1.5 billion budget deficit than raise taxes, which I guess is a little better since you're not pulling money out of the economy, but it's still a bad financial decision because now we have about $100 million of tobacco settlement money that's not going to be available, and you create a $100 million shortfall in future budgets that you need to come up with the money because, heaven forbid, we reduce spending within the government. So having that, I think, would be imperative long-term to help states budget and have a better discussion on what's the real impact of bonding and taking money out of the system and locking in not only our generation, but our future generations. I have a colleague, she's pregnant right now, and she's still up in college, and say, my kid is literally going to be paying for this bond when he or she is 30 years of age. And it was kind of like that. Luckily, she was pregnant at the time because it was kind of a visual within the House Republican caucus to say, oh my God, what are we doing to that poor kid 30 years from now? We're taking that bond. So having that bonding out of that to incentivize, again, tax policy is you're incentivizing behavior and you're disincentivizing behavior. What can we do to incentivize the economy? Create productive members of the economy where people want to earn more and want to spend more and want to grow their business, not disincentivize that.
Do you see a risk that property taxes could go up in Pennsylvania, and then perhaps for you, Jonathan, in other states, if the current proposal goes forth, retaining the property tax deduction but not the others?
I think so. Again, you're incentivizing property tax increases because while individuals may pay that, and listen, property tax is probably one of your biggest, broadest taxes. It touches everyone in the scope of taxation. You know, we have a lot of deductions in Pennsylvania. 80% of small businesses pay the PIT. Retirees, we don't have we don't tax retirement under our income. So it really will incentivize school districts, municipalities, counties to increase that. And they're going to use an excuse. Listen, it's a write-off for you. You know, they belittle pulling money out of the economy in a broad-based way to it's just a federal deduction. They're not having that discussion of what are we spending money on, what in our education system is worth funding moving forward. It's just a simple, tax deduction. We have a lot of school districts that raise taxes every single year, and ironically, our reserve accounts for school districts are going up too. So I'm not sure where they're spending their money or why they need tax increases every year when the reserve accounts are growing. But the regular citizens, they're not discussing what they do or don't need to fund. So I think you're incentivizing constant increases in property taxes, and you'll increase decision-making from pushing costs from the state level down on local governments as well. I think you'll incentivize mandates from the state down to local governments, even from the federal government down to the local governments. We in Pennsylvania have the Chesapeake Bay watershed. Has been a multi-billion-dollar cost to our local governments. It's a federal strategy to try to clean up the Chesapeake Bay. What's the incentive of the state incurring those costs? And we can go back to our locals and say, you guys deal with it. You can write that off a lot better, or your property taxes now. So it really incentivizes pushing a lot of costs down on the local governments, as well as move away from that discussion of what are we actually paying for, and kind of dehumanize that tax to just a federal write-off.
Yeah, well, I would agree with everything Representative Grove said there. This is back to Econ 101, basically. I mean, when you tax something, you get less of it. When you tax something less, you get more of it. Basically, you're incentivizing property taxes to go up. Local governments who want to spend money don't need any extra incentive for increasing property taxes. Now, they might not do it overtly. This is one of the lessons we generally find in the states. Is you look at the most hated taxes, it's gas taxes, the death tax, and property taxes. Those are the three when you look at public polling on taxes. And the reason property taxes are so hated, for good reason, is they're very visible. Unless you pay your property taxes in escrow, you're cutting big checks to local governments. And people see the connection between taxes and spending. And if you're making that easier to do, I think that's something that's going to alarm people. But the sneaky way that we see it usually done is through assessment-driven property tax increases, where people are not taking votes on property tax rates, but they're just having assessments go up, in some cases artificially high, to finance local government spending. So we'll see. I mean, back to Econ 101, as Art Laffer says, this isn't rocket surgery. When you put in an incentive to do something, it will change people's behavior. And let's hope for the best of taxpayers out across the country that property taxes will not go up as a result, but we're giving them all the incentive to go up.
Rachel, the policy has a $10,000 cap. Who's affected by that, and how will potentially higher property taxes affect citizens in various states?
So the cap will basically be significantly higher than the majority of Americans. They won't be affected by that. Looking at the IRS statistics, it's not until the average person makes about $700,000 a year that their property tax bill is going to hit that $10,000 mark. But for people living in California, New York, New Jersey, places that have very high property taxes, they'll be hit significantly sooner than that. Pardon me here. I looked at it's about 1 in every 200 taxpayers that would be affected by this cap here. But then the negative part of this is that if you're doing something that's altering the way local officials are going to do their taxes, by having that cap in there, you're actually encouraging them to have a more regressive local property tax structure, because if they raise taxes on the amount that are up to that $10,000, it's deductible. But if you're raising taxes either a straight increase across the board, or if you're talking about, okay, we're going to raise taxes only on property values over $1 million, there's no deduction there. And so the incentive is instead to push it down the scale and to raise taxes on those middle value homes and properties.
Let's talk a little bit about some of the positive changes in the current tax reform proposal, some of the rate reductions and things that can be achieved by eliminating loopholes like the state and local tax deduction. What are you most excited about in the tax reform framework?
Well, a couple of things really stand out is I think on the corporate tax side, this is a very, very strong free market reform. I mean, I think the Wall Street Journal's pointed out this on the editorial page that this is a great move for the corporation side of things. Maybe less excited about the individual side of how it worked out with some of the provisions, although that kind of opens the question of if the rest of the SALT deduction were to be repealed in the process that's going to unfold in the next few weeks, what would that finance in terms of helping make sure that no one on the individual side sees a tax increase? Or let's say maybe parity between small business and C Corp rates to the 25 versus 20 that's currently in the plan. There's, I think, a lot of opportunity to use that roughly $400 billion that's out there over the CBO 10-year window on the property tax deduction side to further buy down rates in a pro-growth way. This is, I think, a huge opportunity. Getting the rate down to 20% alone would be, according to Kevin Hassett at the Council of Economic Advisors, their study, $4,000 for every man, woman, and child in the United States in increased income. So just that part of it is a hugely pro-growth aspect. And you look at things like killing the death tax, even though it doesn't happen until year 6, I believe, under the plan currently, getting that out of the code is a massive win for taxpayers. Of course, the benefits of that do not just accrue to those that are often painted as the beneficiaries. It accrues the entire economy across the board. And what it means for taxpayers and small business owners and farmers and ranchers, it's an amazing benefit. So there's some really great things in the plan. Now let's hope over the next few weeks as this process unfolds, they'll be able to make it even better in terms of free market growth.
So the good parts of the plan, as you said, Jonathan, the corporate side looks very good, small businesses as well. We've gotten rid of the AMT. That's a big move forward. And if you look at the lower to middle income level, the first thing that is great for simplification, one, and also for reducing overall tax burdens is doubling of the standard tax bracket and getting rid of the personal exemptions. And so now you have significantly fewer people will need to keep track of things and itemize their deductions. We estimate that instead of 30% itemizing, it would be 15% just from getting rid of the standard deduction. When you add on the state and local property taxes, it goes even lower. So you have a big portion of Americans that can essentially file a single page, maybe even a postcard type tax bill, and that's great news. Also, there's lower rates on the lower to middle income level, and so that's a positive thing. The biggest negative thing I see in this is that you do have a group of taxpayers in there, those making about $200 to $250 up to maybe $500,000 that are actually facing significantly higher tax rates. They also have fewer deductions, and so on net, these people are going to be paying probably tens of thousands more in taxes, and then you haven't gotten down that top rate. The top marginal tax rate really does matter. Yes, only fewer than 1 out of 100 taxpayers are paying that top rate, but 1 out of every $20 in income is taxed at that top rate. And so, I'm sorry, that's 1 out of every 5. It's 20% of all income is taxed at that rate. And so that's a lot of economic activity that's happening at that level. And so that 39.6% rate, keeping it and actually adding on a almost 46% hidden rate and a small window in there has significant implications for not being able to make this as pro-growth as it potentially could be. And that's something that you could get rid of if you were to just take the whole full swoop with the state and local tax deductions, put the property taxes in there and add the municipal bond, and I think you could do more than get that top rate down to 35%.
You know, I'm really excited about the fact that the federal government is just talking about giving money back to its people. It's been an exciting conversation I've been waiting for a long, long time. And like past 3 years since we've had our new governor in Pennsylvania, all we've been doing in the conservative branch of the House Republicans is just stopping taxes, stopping tax increases. So just having that conversation of spurring the economy through tax reform changes, handing money back to the people who can spend it better than their government, cost containment. Do we need trillions and trillions of dollars of new government? Talking about not raising the debt ceiling is just exciting, and I think to hear Congress that they're kind of interested in doing and they're trying to get it done is also exciting because they don't necessarily have the best track record on advancing kind of conservative free market principles through their legislative process. So it's a huge win for the American people. So just I'm so thankful we have a president, we have a Congress looking to do some substantial tax reform changes to change the course of where we've been on, and really even going back to the Bush years, going all the way back 20 years to President Reagan when we've seen substantial tax reform. It's just an exciting time, and I hope they continue to move forward, and I hope they continue to look at these tax deductions and focus on rate cuts. Rate cuts is the most important thing you can do in government. We in Pennsylvania, we're known for our corporate welfare, and I'll tell you, it just does not work. It doesn't work. It does not work short term. It does not work long term. The best thing you can do within your tax policy is just cut the rate. You will see great growth. You will see a better economy. You'll see more people working. You'll see more people energized. And when you're in government, you'll have less problems. A strong economy always equals less problems for those in elected office. So if Congress wants to increase their approval rating, what's that, 1% now, to 3 or 4%, cut taxes, grow the economy, and people will stop calling you. You'll have less problems to deal with. Make yourself have less work by making the American people get back to work and grow the economy.
That's a great point. And, we have suffered through the weakest economic recovery coming out of a recession since World War II. That is a tax on every single hardworking taxpayer across America. Low, middle, high-income earners are paying the price for no economic growth. And this, even made perfect, this has a potential to really unleash economic growth again in this economy. And it's a net $1.5 trillion tax cut over the 10-year window. And the last time to see something more significant than that, you'd have to go back to Ronald Reagan in 1981 with those historic tax cuts. So this is I think will be a shot of adrenaline if we can get a few of these things worked out on some of the details.
I'm going to ask perhaps another question or two, and so I just wanted to alert all of you in the audience, if you have questions, think about them now because you'll have a chance to ask them in a moment. Jonathan, you just really brought that point home. This is a once-in-a-generation opportunity to really make a difference, reform taxes, cut taxes, and the economic growth that could bring about. You and your organization with ALEC, you've been working a lot on the state level to drive this tax reform. Can you tell us a little bit about how you've been working on the state level with lawmakers and others to move this reform forward?
Well, yeah, we work every single day at our Center for State Fiscal Reform at ALEC, and I want to give a shout out to my team who's all here doing a fantastic job each and every day, going out, working on behalf of the taxpayer in our 50 state capitals, trying to make a difference, and we are making a difference at the state capital level. Just in the last 4 years alone, 30 states have significantly reduced their tax burden, according to our research. We're seeing that momentum for more efficient provision of government service, lower taxes, win the day at the state and local level. When those decisions, as I mentioned earlier, are happening at the state and local level, that's where fiscal conservatives and that's where taxpayers win. This is a generational opportunity. 31 long years ago, Ronald Reagan signed the 1986 Tax Reform Act into law. I was just down at Ways and Means this week, and I couldn't help but think, looking across the room of people sitting there weren't many people in that room this week than were there in 1986, the last time this happened. Interesting in just how this is playing out. And the unfinished business, interestingly enough, getting back to SALT for a second, the unfinished business of 1986 was the SALT repeal. This was Ronald Reagan's issue from 1986 that he was not able to get done because this coalition of folks that oppose reform came together and put the political pressure to stop the SALT repeal of 1986. We're back to where we started, and we have the ability this year to finish the unfinished business of Ronald Reagan from 1986. But back to the states, it's very good news. I mean, we are seeing wins every single year. The two big case studies that get talked about a lot based on reforms at the state level. One, Kansas, which has been talked about a lot by the left and saying that you can't cut taxes because it's ruined the state of Kansas. We could have a whole panel on why that's wrong. But the short answer of it is, at the state level especially, if you're going to cut taxes, you need to control spending, and you need to have pay-fors. And Kansas did not do those basic things in terms of balancing a budget with tax reductions. And they, of course, were hit by a downturn in the ag economy and the oil and gas economy at the same time. It's much more complicated than the critics of Kansas would point out. But then the other one, and this is the optimistic note for those of us who believe in lower taxes and limited government, is North Carolina. I mean, they're a state that has gone from mid-20s in rich states, poor states economic outlook all the way up to number 2. Over the course of just several years under Governor Pat McCrory and the legislature. They cut taxes across the board. They turned a progressive tax system into a flat tax, cutting rates on each and every taxpayer that paid taxes in North Carolina. They killed the death tax, similar to what's being talked about here at the federal estate tax. And they cut taxes across the board on businesses and individuals. What have they seen? They've seen some of the strongest GDP growth in America. They've seen budget surpluses year after year in the hundreds of millions of dollars. They've seen teacher pay increases because they've been able to finance that through surpluses. And at the end of the day, they've kept their AAA bond rating because they did it in a responsible way, which is when you cut taxes, you reduce the growth of spending, and you have pay-fors to make sure that's done in a balanced fashion. Once again, Romina, Economics 101. It played out in North Carolina.
That's very exciting. Do we have any questions from the audience? If I call on you, please keep your question short, and please do not take too much time to comment, or I may have to cut you off. I think you had your hand up first, you, and then you. Thank you.
Thank you. My question is related to the return, the legislator, the reform can take from the the federalism experiment since the Constitution started until now. There's many experiments in different states. You can think about North Carolina, you just talked about, Kentucky, Texas, or Florida. And in the other hand, we have New York, we have California, Illinois. So how did the reforms learn about those experiments and sum them up to make something better out of this proposition?
So what state lessons were worked into the federal tax reform effort? I think that's what I gathered.
Well, I mean, I think, part of that is they learned the lesson of North Carolina, which is pro-growth tax reform brings about a lot of growth when it comes to being done the right way, when you balance it, when you include pay-fors, when you do it in a responsible fashion. You look at the taxes that are most valuable to cut. So not all tax cuts are created equally. That's something we say a lot at the state level. Tax cuts on capital. And this comes from OECD and the academic research out there. Tax Foundation's done a great survey of the academic literature. Tax cuts on capital, tax cuts on income. These are the most damaging forms of taxes out there, and it's important when lawmakers focus on those first. That's what the experience of North Carolina taught us. They focused on capital-based taxes, and we've seen a great success of what that's done for their economy. Looking at some of the other tax cuts across the states, not nearly the kind of growth impact because they focused on other things. One of the most popular things to do is reduce the local property taxes by increasing state taxes elsewhere. So it's this kind of rearranging the deck chairs type game where you don't get any kind of growth out of that generally. You see the distribution change, but you don't see the economic growth. So there's different models that we've seen work out, but certainly the model of cutting capital-based taxes and getting things in order in terms of the most competition-based taxes, that's what we've seen work the best.
Thank you. We had a question right here.
Thank you. Dominic Hayden, working for Congresswoman Mimi Walters of California. I have two quick questions. First is for Rachel. Did you say that 15% of people under $75,000 a year income are itemizing?
Yes, let me make sure that's the property tax deduction, if you're making under $100,000, 15% of those are claiming the property tax deduction, 18% are claiming state and local as a whole.
Oh, okay, got it. And then a general question, in terms of the people in California, it's not necessarily their fault that their states are charging such high taxes. So what would you say to somebody in California whose taxes are going to go up because they'll have to be paying more in federal taxes?
Exactly. I think that's a great point to make here, is that you see those states that have the high taxes saying this federal tax bill will be so bad for New York, for California, for our residents. But the problem is not the federal tax policy. The problem is those state and local taxes. I mentioned that you have some people that are deducting $500,000 in state and local income taxes. That is an obscene amount of money, no matter how much you're making. You know, that is a crazy tax that's being assessed on these people. And just comparing across the U.S., you know, the average 75 to 100K household, there are huge differences between lower tax states like Texas and Tennessee and New York and California. And yet, if you surveyed those people, I don't think that you would say it's 5 times better, the services we receive in California, than the people in Texas do. You're actually having a lot of people moving from California to Texas because of the lower taxes and because of better opportunities there. And so I think for those people, they need to be questioning their state and local governments. What are you doing with all this money? Is it really necessary for you to be taking that much away from my paycheck?
Well, yeah, the short answer is reprioritize spending and get taxes down at the state and local level. That's easier said than done. But let me say one thing is, I think the folks that are most been out of shape, let's say the New York, New Jersey crowd of Andrew Cuomo and maybe Chuck Schumer would fall into this. You know, it's at least instructive, I think. It's very interesting that now they realize that taxes matter. You know, they spend all this time raising taxes and saying that it's not going to affect people's behavior. Now they're saying, well, this deduction goes away, our tax bill relatively goes up in some cases, and that's a problem. That's a great point to remember for future tax battles. But secondly, maybe for Republicans from those states, is you have an amazing amount of political capital to use in future state and local tax issues. All this anger over this right now is certainly well placed in some cases, but what about the future, right? Spend that political capital in fighting in Sacramento, in Albany, in Trenton, in the towns and cities and counties all across those states. And I think that would be our message, is let's have those battles at the lower level. And we're more than happy to stand with you in those battles, as we're going to fight them each and every year.
Andrew, the gentleman over here had his arm up. Thank you.
Hi, Daniel Bunn with the Joint Economic Committee. So there are multiple other connections with state tax policy to federal tax policies. A lot of states rely on the federal definition of adjusted gross income. So there could be windfalls to some taxpayers for paying their state taxes. So this is just a general question. What other things would you be looking at as state lawmakers in this federal tax debate?
Yeah, I mean, Pennsylvania, we're not connected with the federal income tax whatsoever. Ironically, there's been more discussion with that moving forward. Just a general overall tax discussion we've had. I don't know where this will send us moving forward, but I mean, we're blessed. We don't have a progressive income tax. It's 3.07. It's flat. You can do your income tax basically on the back of a napkin, which would be great for the federal government to go to that extent, so it wouldn't have to pay like $300 or $400 for an accountant to do your simple household income tax filing at the end of the year. But though I know colleagues of mine are going to have to make determinations to see how, when this is all said and done, how that's going to affect them moving forward with the different tax changes, and probably Jonathan would know better than I would personally, because we don't have that issue in Pennsylvania.
Yeah, I mean, one thing that we're looking at, and this kind of harkens back once again to 1986, is depending on how the final package looks, if it happens this year, we're talking to state lawmakers a lot about what to do with perhaps unexpected revenue that was not budgeted for with base broadening. You know, we saw that phenomenon after 1986. States and local governments had a lot of unexpected income coming in with their tie-in to the federal code, and we could be facing a situation along those lines, maybe not as dramatic with the amount of revenue that will be coming, but I think it will provide state and local officials with an amazing opportunity. On one hand, there will be the threat of state and locals wanting to raise spending with additional unforecast revenue coming in if federal government is successful, but they will also perhaps have a generational opportunity to use that money to buy down their rates again. So that's something that states, I think, are very much looking forward to if base broadening provisions do come out of this reform, as it looks they will.
Question here in the front. And this will be our last question from the audience. And then
Okay, thank you. Thank you for being with us today. Michael Maybach with the Heritage Foundation. The compromise on SALT apparently is this exemption for property taxes, which might skew things. Would it have been better for the compromise to have simply put a cap on the state and local rather than to pick one and not the other tax?
From a public policy, probably from a political standpoint, what's Congress getting out of that deduction? Ideally, if I'm looking for votes and I'm counting my votes and I cut a deal to leave that property tax exemption in there, am I getting your vote? Is New York, New Jersey still voting with me if I do that? Or are they saying, thanks, go pound saying I'm still not voting for your tax package at the end of the day? If they're not willing to put up the votes, why am I even worrying about that? I can take that money and do greater tax cuts, which is going to spur the economy more than worry about those legislators that are having issues with it, but ultimately not providing votes to get this done. And I want to go back and thank you for your service. Being a staffer is not the easy thing. You take all the bullets for your boss sometimes. So thank you for your service. Yeah, even probably worse. Everything flows downhill, right? But in the back of your head, a lot of these guys and gals in these high tax areas are thinking, am I going to get through re-election? A lot of Republicans. And you go to the fundamental difference between the politics of the Democratic Party and the Republican Party. I would say Republicans a little more independent. Democrats, they go lock and step. Even in Pennsylvania General Assembly, once that decision is made, they're all generally in lock and step going down that direction. We have a chance for substantial tax reform to the tune of, we won't see this for another, we won't see this. This is it. This is our shot to change the direction of our economy and the direction of our country. If we do not take this opportunity now as a party and as elected officials, this chance will escape us, and we will never come back to this point again. So for those individuals who are worried about re-election, from what I've seen in voters tend to start rewarding leadership and moving into a better direction. I think they're tired of politicians saying, oh, I've brought this amount of money back to my district. They're not interested in those. They're interested in making their lives better on a day-to-day basis. By building by providing a tax incentive for some business, that's not bettering their day-to-day lives. This tax reform will better the lives of American citizens now and into the future. And that's a direction we need to focus on as simple residents. I hope people out there pull in Tom Cruise. Show me the money, right? Start screaming. Call your congressman. Call your U.S. senator. Show me the money. I want to see my weekly wage increase because the government's not taking more out of it. That's what's going to change our country. That's what's going to change our economy. And that's what Congress needs to focus on, the long game. And that's what the Democrats did with Obamacare. They looked at it. They all voted together. Given they lost elections the next year, but the American people didn't reward them for success or making changes that are beneficial to their day-to-day lives. And I think if Congress gets that message and keeps moving forward, they will not only be rewarded, but the American people will be rewarded.
Thank you, Representative Gross. I'd like to ask all of you to, if you will, just speculate a little what might happen with the bill as it moves through the Senate, and especially with the SALT provisions that are still in there. Whoever would like to go first?
Well, I've almost given up on prognosticating after this last year or so. That being said, I do think this is one of those perhaps rare times when the bill may get more free market on the Senate side when it relates to salt. So thinking about the political dynamics for a moment, there's no Republicans that represent high tax states basically anymore. I mean, Pat Toomey is probably the exception, and Ron Johnson, and both are very free market in their leanings and their vote record. So I think the full salt repeal gets easier on the Senate side, and hopefully then they can look at that $400 billion pot to say, how can we fix a few of these other issues that we've been pointing out? So at least on that issue, I think it gets easier. Maybe on some of the other issues like full death tax repeal and some of those, it may get a little bit more challenging depending on those few senators that seem to be the makers of majorities over there in the Senate these days.
The only thing I'd add to that is you open the door again to discussion over what are we keeping, what are we getting rid of. The tendency is going to be to try and get some things back in there that were already taken out of the previous bill, and so hopefully they don't go in that direction.
Thank you, all three of you, for joining us today to talk about this important issue. Exciting times. I'm really curious to see what happens with tax reform, and I'm so glad that it's moving in the right direction. And so I wanted to thank you for explaining the SALT issue in greater detail, and thank you and our audience today for being here and participating in this event.
Thanks.